Have you ever wondered how some people manage to earn money while they sleep? No, it's not a trick question. The reality of the matter is that you need to make money while you sleep, eat, go to the gym, just to keep your head above the water and avoid getting into debt. And to be able to do this, your investments need to work tirelessly for you day and night. This is why, in today's video, we've got you an investment strategy that is not just simple and profitable, but also sustainable. Dividend investing. Dividend investing is about owning shares of companies that pay you a portion of their earnings regularly. Think of it as being a silent partner in a thriving business, where you reap the benefits of the company's success without lifting a finger. On top of it, we have cherry-picked the top 4 dividend stocks that you should invest in 2024. So, what stocks are we talking about? Let's jump right into it. What makes a great dividend stock? When we dive into the world of investing, one term that frequently pops up is dividend growth, and for good reason. At its core, dividend growth is about companies increasing the amount they pay back to their shareholders annually. This isn't a one-time bonus, but a consistent uptick, reflecting the company's growth, profitability, and stability. So why does this matter? Because it's a sign of a company's health and commitment to returning value to shareholders. In a world where financial stability is golden, companies that pay dividends and consistently increase them are the golden geese. They offer a double layer of rewards: regular income through dividends and the potential for your investments to grow as the company thrives. Now, let's talk about benefits. Investing in these dividend growth companies is like planting a tree and watching it bear fruit year after year. The initial dividend might seem modest, but with each increase, your income grows. Over time, this can lead to a significant source of passive income, helping to build your wealth and secure your financial future. It's not just about the immediate gratification of receiving dividends. It's about the long-term vision of creating a sustainable and growing income stream. But why dividend stocks? With dividend stocks, you get to have the growth and stability that an investment needs for a brighter financial future. And you also earn income from this. Having said that, let's look at some of the dividend stocks that you should definitely check out and invest in. Let's start with the iShares Core Dividend Growth ETF, known by its ticker DGRO. DGRO is a $25.80 billion ETF managed by BlackRock's iShares, and it aims to mirror the performance of an index comprising U.S. equities known for consistently increasing dividends. These companies span various industries, ensuring broad diversification for investors. When a company consistently increases its dividends, it typically indicates steady earnings growth, making the stock appealing for dividend income and potential capital appreciation. DGRO offers investors a well-rounded selection of dividend-paying stocks while offering significant diversification. The ETF holds 425 stocks, with its top 10 holdings representing only 27.26% of its assets, minimizing concentration risk. This blend of consistent dividend growth and diversified holdings makes DGRO an attractive option for investors seeking both stability and potential returns. By December 31st, 2023, the fund achieved an annualized return of 8.8% over 3 years and an impressive 12.9% over 5 years. Looking at cumulative returns, DGRO boasts a solid total. With an ultra-low expense ratio of just 0.08%, investors pay a mere $8 in fees annually on a $10,000 investment. Assuming this expense ratio remains consistent and the fund returns 5% per year, an investor allocating $10,000 into DGRO would pay only $100 in fees over a 10-year investment period. This cost-effectiveness makes DGRO and similar low-cost ETFs invaluable for investors. helping them save, earn, and steadily grow their portfolios over time. WisdomTree U.S. Quality Dividend Growth Fund, DGRW. Launched on May 22, 2013, the WisdomTree U.S. Quality Dividend Growth ETF belongs to the smart beta category of exchange-traded funds, offering broad exposure to the large cap value segment of the market. But what exactly are smart beta ETFs? Traditionally, the ETF industry has been dominated by products based on market capitalization, weighted indexes designed to mirror the market or specific segments of it. Market cap weighted indexes are favored by investors who believe in market efficiency, as they offer a low-cost, convenient, and transparent way to replicate market returns. However, some investors believe in the potential to outperform the market through strategic stock selection. This belief leads them to invest in smart beta funds, which track non-cap weighted strategies. Smart beta indexes share the same philosophies, aiming to select stocks with better potential for risk-return performance. Instead of relying solely on market capitalization, these indexes base their stock selection on specific fundamental characteristics or a combination thereof. The smart beta landscape offers investors various options, from simple equal-weighted strategies to more intricate approaches, like fundamental and volatility-based weighing. Expense ratios are crucial in determining a fund's overall return for ETF investors. Over the long term, lower-cost funds have the potential to outperform their pricier counterparts, all else being equal. The annual operating expenses for this ETF stands at 0.28%, aligning it with most other similar products in the market. Moreover, it boasts a 12-month trailing dividend yield of 1.67%. DGRW's largest allocation is in the information technology sector, constituting approximately 28.90% of its portfolio, followed by healthcare and industrials. Among its individual holdings, Microsoft Corp represents around 7.84% of the fund's total assets, followed by Apple Inc. and Johnson & Johnson. The top 10 holdings comprise about 37.92% of DGRW's total assets under management. In terms of performance, the ETF has gained approximately 5.37% year-to-date and 22.88% over the past year as of March 1, 2024. With around 300 holdings, it effectively diversifies company-specific risk. Vanguard Dividend Appreciation ETF, Viig. The Vanguard Dividend Appreciation ETF, Viig, is another smart beta exchange-traded fund that debuted on April 21, 2006. Managed by Vanguard, it provides broad exposure to the large-cap blend category of the market. With assets totaling over $75.62 billion, Viig also ranks among the largest ETFs in this category. The fund aims to replicate the performance of the NASDAQ U.S. Dividend Achievers Select Index before fees and expenses. The NASDAQ U.S. Dividend Achievers Select Index comprises common stocks of companies with a track record of consistently increasing dividends over time. Viig also stands out as one of the most cost-effective options, with annual operating expenses of just 0.06%. Moreover, it offers a 12-month trailing dividend yield of 1.79%, providing investors with attractive income potential. So, what are some of the holdings in the fund? The fund's heaviest allocation, representing 23.50% of the portfolio, is in the information technology sector, with financials and healthcare rounding out the top three sectors. Among individual holdings, Microsoft Corp accounts for approximately 5.54% of the fund's total assets, followed by Apple Incorporated and JP Morgan Chase & Company. The top 10 holdings collectively represent about 32.16% of total assets under management. In terms of performance, the ETF has gained about 13.75% year-to-date and 18.53% over the past year as of March 1st, 2024. With a beta of 0.8 and a standard deviation of 15.11% for the trailing 3-year period, the fund is also considered a medium risk choice within its space. With approximately 318 holdings, it effectively diversifies risk. Schwab U.S. Dividend Equity ETF, SCHD. The Schwab U.S. Dividend Equity ETF is another excellent investment for investors seeking a blend of income and growth. Launched on October 20th, 2011, this passively managed exchange-traded fund, sponsored by Charles Schwab, has garnered assets exceeding $53 billion, establishing itself as the largest ETF aiming to mirror the large-cap value segment. Large-cap companies typically boast market capitalizations exceeding $10 billion, offering stability and more predictable cash flows compared to their mid- and small-cap counterparts. Value stocks, which constitute the focus of this ETF, are characterized by lower-than-average price-to-earnings and price-to-book ratios. However, investors should note their comparatively slower sales and earnings growth rates. Despite this, value stocks have historically outperformed growth stocks over the long term, although potentially lagging behind during robust bull markets. So, how does this stock perform? With an annual operating expense of just 0.06%, SCHD also stands out as one of the most cost-effective options in its category. Moreover, it offers a 12-month trailing dividend yield of 3.40%, providing investors with an attractive income potential. Its heaviest allocation is in the industrial sector, comprising approximately 17.30% of the portfolio, followed by financials and healthcare. Among individual holdings, Broadcom Inc. represents about 5.09% of total assets, followed by AbbVie Inc. and American Co. Inc. The top 10 holdings collectively account for approximately 42.20% of total assets under management. SCHD seeks to replicate the performance of the Dow Jones U.S. Dividend 100 Index before fees and expenses. This index is designed to gauge the performance of high dividend-yielding stocks issued by U.S. companies with a consistent dividend payment record, selected based on their fundamental strengths relative to peers as determined by financial ratios. Passively managed ETFs are becoming increasingly popular among both retail and industrial investors due to their low costs, transparency, flexibility, and tax efficiency, making them excellent vehicles for long-term investors. But then, how can you build a diversified dividend portfolio? When investing, creating a diversified dividend portfolio is a crucial milestone. This isn't merely about gathering a collection of stocks that pay dividends. It's the art of balancing yield with growth, stability with potential, and spreading your bets across sectors and geographies to manage risk. By incorporating a mix of ETFs, like the ones we just discussed, investors can tap into a broad array of companies across different sectors with just a few investments. These ETFs, each with unique selection criteria and sector exposures, provide a solid foundation. However, the magic lies in how you combine them. A balanced portfolio might allocate investments across these ETFs based on their performance, dividend growth rates, and the sectors they emphasize, ensuring that no single investment's downturn unduly impacts the overall portfolio. The allure of high dividend yields can be tempting, but savvy investors know the importance of balance. High yields are often accompanied by higher risks or the potential for dividend cuts in the future. Thus, including ETFs and stocks that offer not just high yields, but also demonstrate consistent dividend growth and stability becomes paramount. For instance, Viig's focus on dividend growth stocks counterbalances the high-yield attraction of other investments, offering growth potential and stability to the portfolio. Sector diversification ensures your investments are spread across different industries, from technology to healthcare, consumer goods to energy. This approach mitigates the risk of sector-specific downturns, specifically impacting your portfolio. Meanwhile, geographic diversification, though less emphasized in portfolios focused on U.S. dividend stocks and ETFs, can still play a role. Considering global dividend payers or ETFs that track international markets can provide exposure to different economic cycles and opportunities, further spreading the risk. In the end, building a diversified dividend portfolio is not a one-time task, but a continuous process of assessment and adjustment. It requires keeping up with market trends, evaluating the performance of your investments, and being ready to rebalance your portfolio as needed to meet your financial goals and risk tolerance. So, what are your thoughts on these remarkable dividend stocks? Share your thoughts in the comments below, and don't forget to give this video a thumbs up and subscribe to our channel for more insightful content. Until next time, happy investing!